Hey guys, Josiah here with EasyGators.com. I wanted to go over a important aspect of trading today, which is risk management. So I know when I initially got into trading several years ago, I completely ignored this subject altogether. I just started putting on random trades, didn't have any method for determining how many shares of a stock that I was going to buy or anything like that. I was just, kind of picking that in the moment, saying, this number sounds good, and, putting on a trade and seeing what it did. But I eventually learned that all pro traders um, take risk management really seriously. And if I was going to stay in this business, then I knew I needed to start taking it more seriously myself. And so um, I learned several different methods of, sizing positions and managing risk and so forth. And so I wanted to go over those today and just kind of show you how I size my positions and how I keep my risk manageable across a series of trades and so forth. So, and one thing I wanted to note first of all is that I know there's a lot of confusion over the actual buying power that's required to put on a trade versus the amount of risk that you're going to allow or the amount of dollar loss or percentage loss that you're going to allow that position to um, take or move against you in the case that it doesn't end up working before you would actually close the position out. So I consider the risk management uh, to have nothing to do with the buying power at all. So, say you buy 100 shares of a $50 stock, that's going to cost you $5,000 of buying power. But you don't want to risk that $5,000, losing that whole $5,000 on a single trade. You want to limit that risk to maybe, you know, $2 a share or something like that, so that where, if you enter the stock at $50 and put a stop at $48, then you have $2 of risk per share. And if you buy 100 shares, then that's $200 of risk that you're taking. So that's how I consider that's what I consider the risk aspect of this, the risk size of my position. And so when I take positions in a market, I find out what the stop size is going to be and then calculate how many shares I'm going to buy based on that stop size. And I set my target based on that as well as a multiple of that stop size. So let me just go over uh, some ways of figuring that out. So, but again, buying power is not the same thing as risk per trade. Um, I essentially want to take a certain amount of dollar risk per trade. Usually you want to determine what that dollar amount is based on the size of your account. So, you know, if you have a $100,000 account, you don't want to be risking 50,000 on every position, because if you have two losing trades, then you've lost your whole account. You want to risk a small portion of your account on each trade. So a lot of times people will say between 1 to 5% of your account. I know a lot of the more conservative traders don't think 5 is acceptable. So, I think 1 to 2 is generally accepted as a reasonable amount of risk to take on your account. So if you have a $100,000 account, you would only want to risk either $1,000 or $2,000 per position. Um, Personally, I stick to 1%, and I'm a pretty conservative guy. So that's what I do. But I know with smaller accounts, it's harder to stick to those low percentages. So if you're willing to accept a little bit more risk of, blowing up your account, then you can, up that percentage uh, as you see fit. But 1%, 2%, that's a good guideline to kind of stay around. So as an example here, on a $25,000 account, 1% would be $250 of risk per trade. Again, that has nothing to do with the buying power. The buying power might be 5,000 or 10,000 or whatever that's required to put on the position, but you're only going to let it go against you $250 of loss in this particular case. Or on a $100,000 account, 1% would be 1,000. So, just as an example there. Whatever number that you pick there, whatever percentage of your account size, I just wanted to mention that it's important to choose an amount that you're going to be comfortable, uh, you know, without hesitation taking the next trade, even if you come off of a string of 3 to 5 losers in a row. Is this an amount that you would be comfortable risking on the very next trade, on the fourth or the sixth trade after you just lost 3 trades in a row or 5 trades in a row, whatever? Um, are you going to be level-headed enough to go ahead and put on the next trade and risk that amount one more time? And so make sure it's at an amount that you're comfortable with. Also make sure that that amount is not going to change your financial outlook at all. You want to be sure that this is money that you are you don't want to lose money, but you definitely need to be comfortable losing money when you're a trader, because trading is a matter of probabilities. It's uh, you know losing is just a reality in the trading game, and what's really important is that after a series of maybe 20 or 30 trades, you have a gain after that sample of trades is done. Each individual trade is irrelevant in a way. Uh, it's the set of trades that matters, and whether or not that's a positive net gain for your account or a loss for your account. So uh, just be ready for losses, and so make that number, whatever number you choose, something that you're comfortable losing several times in a row. Um, so anyway, as far as actually how do you execute this type of system, so say you've decided, okay, I want to risk $100 on every trade. Well, how do you actually size your positions to do that? Well, it's a simple equation, and that is you take the amount of dollars that you're wanting to risk on each trade, divide it by your stop size, and that will give you the number of shares. So say you are buying on a breakout over this candle, and we'll just say it's $106, and you're putting a stop at $104. So that's a $2 stop. And so you would take your $100 and divide it by 2, and that would give you 50 shares. So $100 risk divided by $2 stop equals 50 shares to buy. So that's how that equation works, and it's really simple. But for quick execution, especially for day traders and so forth, what I like to do is to just put a little post-it note on my computer, and just kind of have a quick reference sheet. Okay, 5 cents means 2,000 shares. 10 cents means 1,000 shares. 15 cents, and these are the stop sizes. So if I have a 20-cent stop, then I need to buy 500 shares. And so you can calculate these all out in advance for whatever size position or size risk that you want to take per trade, and then post this somewhere on your computer or your desk or something, or even like on a Mac, I have a little sticky note here where I can size based on that. And you can also have a calculator handy where you can calculate this out. That helps to have as well. But anyway, so post-it note or something like that to just give you a quick reference to know how many shares to buy at each stop size. Oh, and I did want to mention that sometimes it's best to round these numbers down or up if you're close to a whole number. So like 667 in the stock market, a lot is, or one lot is 100 shares. So it's easier to get your order executed or filled if you have your sizes, your position sizes sized to even 100s, or at least maybe 50 excuse me, 50 share increments. So just kind of play that by ear. Like in this case, instead of 667, I would probably do 650 or just round up to 700. but you can do that as needed. You can get the exact risk you want by doing 667, and maybe you'll get executed every time, maybe you won't. So I just wanted to throw that in there as a note. The other thing is that you need to take spread and the bid-ask spread and liquidity into account when you're managing for risk. So taking a 20-cent stop, sizing a position to a 20-cent stop on an illiquid stock may not be a good idea, whereas sizing it to 20 cents on a very liquid stock like maybe Microsoft or one of the extremely liquid stocks out there, QCOM or Facebook or whatever, um, that might be perfectly acceptable. So smaller stops on illiquid stocks are not necessarily a good idea. You really need to take the liquidity into account. And essentially, liquidity, just as a crash course, real quick, in the stock market, there's essentially two types of orders: the limits and the market orders. And the limit orders are the patient traders who are sitting there waiting for traders to come along and fill their waiting orders at the different price levels. And market orders are those taker orders that come along and take the limit orders that are waiting. And so the more limit orders sitting there waiting to be executed, the more liquid the stock. Also, the more eyes that are on the stock during the day, the more liquid the stock is going to be, the more market orders are going to be coming in, and they'll be able to match them with yours, perhaps. And anyway, so the liquidity picture matters. So look at the depth of market, the price ladder, and see and make sure that there are actually orders below your position waiting to be filled in case you do get stopped out. You want to be able to be sure that you don't take a lot of slippage, as they call it, an extra loss that would occur in case you get stopped out at $48 or whatever. You don't want the stock to gap down to $47 and you take an extra dollar of loss per share because you weren't aware that there was no liquidity available there. So keep an eye on how many orders are waiting to be filled below your order or above your orders. And as a quick reference for that, the smaller the bid-ask spread, generally speaking, the more liquid the stock is going to be. So if you trade a stock that has, like 1 or 2 or 3 cent spread, that's generally going to be a pretty liquid stock. Whereas, 25, 50 cent spread is a really big spread for a lot of traders. And so that's going to be less liquid. And so you can keep an eye on the bid-ask spread as a kind of quick reference for whether or not the stock is liquid. And try to stick to the ones that have tighter spreads. The other option is that you can just stick to the well-known names that are liquid, like Microsoft and Apple and Facebook and so forth. What I actually do personally is I create a list of pre-picked stocks, essentially, that I know are liquid. I scan for those based on several different criteria like daily volume, per minute volume, per minute trade count. So I look for those different criteria and say, okay, this is a liquid enough stock or likely to be a liquid enough stock that I could day trade it. And then from that list that I compile, I then, splice that or slice it and dice it into different other lists that then I can find my particular setups from. But I only trade from in that universe of stocks that I know are liquid. So that's a strategy for you. Go ahead and pre-make your own universe of stocks or, master list of stocks that you're willing to trade at all. And then from that, you can build your, narrow that down and find your actual strategies on just that list of stocks. I did want to mention that because this is so important, I went ahead and programmed a position sizer for my platform, and I put that on my website for sale for anybody that's interested in that. And so I'm going to just walk you through that real quick. I do have a demo video on the site, so I don't want to get in too much in the weeds here. But essentially, what it does is, you know, um, say I was going to buy a breakout of this, the high of this candle. Um, then this would plot my entry, my stop, and my target based on the criteria that I've given the indicator. And it tells me up here, okay, my entry, my stop, my target, how many shares to buy, what the stop size is here, and how many dollars of risk per share and so forth, and what the risk to the reward ratio is in dollars, percent, and just the ratio in general. And then it tells you how much buying power is required per share and for the position in total. It also tells you the tick size and the tick value for futures traders out there. And it can also add the spread onto uh, the sizing as well for intraday traders on intraday charts. So uh, there's lots of different ways to set this up, but the way I have it currently set up is just for long trades that break over the high of the current candle uh, by an extra penny. And you can also, set the stop type from, the bottom of the candle. You can change it to ATR based stop, CASI dev stops, or just a manual stop size. And if you size it to the candle, you can choose what time frame of candle you want to set it to. Any higher time frame than the chart that you currently have open. Excuse me. So you can see here I'm on a daily chart, but I have the levels set to weekly levels. So my stop is at the low of the weekly candle. My entry is at the high of the weekly candle, and my target is based on that. And you can see if I had bought that breakout, it probably would have achieved target right there. But anyway, so that's how that works. And there's lots of different customization options in there. I'm not going to go over all of them. You can size it to the actual balance of your account in Thinkorswim or set a manual balance. You can adjust it for buying power leverage, and you can tell what percentage of the account to risk on each trade, or you can choose another method of determining the risk size. Lots of different options. You can turn off any of the plots that you don't want if you don't like those lines on your chart and you just want to use the labels, which is how I use it. Lots of different options there. So check that out on my website if you're interested in that. I think that has the potential to help a lot of traders out there avoid, total losses on their account and so forth, just by, giving them a little bit of training wheels to make sure they're taking trades that make sense and buying the right number of shares for the actual risk they're taking on. So just wanted to touch on that. Hopefully this video has been helpful. Do check out the website at easykaters.com. Please like and subscribe to the video. That helps me know that I'm on the right track and that this content is valuable to you guys. So I appreciate that. And other than that, we will talk to you next time. Thanks.